Imagine this. You finally buy a stock after weeks of research. It starts falling, so you set a stop loss to protect yourself. The price touches your stop loss, your shares get sold automatically, and then within minutes, the stock shoots back up without you. This happens more often than people think. A stop loss order is simply an instruction you give your broker to automatically sell a stock once it hits a certain price. The idea sounds smart. Limit your losses, remove emotion, and protect your capital. And yes, stop losses can be extremely useful. They act like a safety net. Instead of hoping a losing trade recovers, you decide in advance how much you're willing to lose, and the system exits for you. This prevents small losses from turning into devastating ones. But here's the catch. Markets don't move smoothly. Prices fluctuate constantly, especially during volatile days. Sometimes a stock briefly dips, triggers thousands of stop-loss orders at once, and then rebounds almost immediately. This is called a stop-loss hunt, where sudden short-term drops force investors out before the real move happens. Another problem is setting the stop too close. If your stop-loss is just a few percent below your purchase price, normal daily fluctuations can trigger it even when the long-term trend is still healthy. So how do you use stop-losses wisely? First, base your stop-loss on logic, not fear. Look at historical price movement or key support levels, not random percentages. Second, avoid setting stops too tight, especially for volatile assets. And third, remember that stop losses are tools for risk management, not guarantees against losses. Used correctly, a stop loss protects you from catastrophic damage. Used blindly, it can push you out of good investments at the worst possible moment. The difference isn't the tool, it's how you use it.